Hi there, this is Charles Goddard, and this is another in our series of mini lessons as we cover some of the topics in my course that I have available, 5 Power Lessons to Stock Market Mastery. And in this one, we're going to look at a very basic and simple trading method. And the main driver here is that it's objective and we're taking ourselves out of the decision making. And if you've been listening to or watching the videos in a series, you'll know that's ultimately what we're trying to do, is to be as objective as we can. We take whatever it is we're looking at, we're taking every trade our system kicks out. So for the year 2020, I traded this basic method using 5 symbols only, and I put that on a blog. It was public, and I took every trade that this method produced in those 5 symbols, and that is you probably have seen it already. The final 4 months of the year I managed to save as a PDF so that you can take a look at what I did and how I presented things almost day to day. So there's no looking back and saying, oh, I would have done this, I would have done that. Is what I did do, and in many cases I said this is where we're going to act if this happens. And so we're going to review that method now, and we're going to revisit some of the concepts, and I'm going to indicate where in the course some of these things will show up. But this is a standalone lesson, as they all are, and you've got material here that you can take away and use right away. So let's get started. But first, let's have a quick look at me. There's that handsome devil on the screen right now. And you can see some of my designations on the right-hand side. And I want to add to that I spent thousands of dollars and untold hours in the company of veteran traders as one-on-one student and in workshops. And these were the chaps who plied their trade in the famous commodity pits of Chicago, and they're the guys that taught me that for all the book learning you can have, if you want to be a consistent trader, you need to bring some practical aspects to your trading if you want to be consistent. And I'm hoping that's what I bring to these lessons and bring to my course for you, and that is balance. So let's get to it. Okay, so we're looking at our chart of Apple, and this must start to be familiar to you now. We've got a couple of places that we can demonstrate our trading method. So we'll start with we've got a sort of a little down here. And what we're looking for is based on our moving averages. So our moving averages are green is 55, blue is 21, and red is 8. And they're all exponential. And we go over this in the course, the difference between simple moving averages and exponential moving averages. So what we're looking for, step 1 in our trade, is we need to have the trend with us. We need, if we're going to go long, we need the trend to be up, and if we're going to go short, we need the trend to be down. So we're not going to address short selling in this one. We're just going to stay with going long. So in order for us to place a long trade, we need the blue moving average to be above the green, and that is a simple definition of trend for us. We don't have to ask any questions, any interpretations. If blue is above green, we're in an uptrend. That is our setup, and in this case, that occurs right around here. Okay, so then the next thing we need is our trigger. We've got our setup, and our trigger essentially is the price or the red moving average moving above the blue moving average. Now, once that happens, once we've got a close of the price above the blue, or we've got the red closing above the blue, then we've got our setup and we have our trigger. Now, the next thing that we do in our process is we look to the left, and within the last couple of months, do we have a price that is higher than where we would be buying? So we would be buying somewhere in here based on what I've just described to you. And as we look to the left, we find out here we have higher price. Now that represents resistance, and we discuss support and resistance a lot in the course because it is a core component to trading. In that, what you've got at the top of at that resistance is you've got a lot of people who've bought and then just watch their money go down. So they're a little miffed, and you know perfectly well what their attitude is, and it's, well, as soon as the price comes back up to a level where I can get my money out, then I'm out. So we don't want to be involved in that bouncing around that may or may not occur. And resistance also, when that price goes through resistance, quite often it's a surefire indicator that the trend is continuing on, and the price tends to run up. And it does that because there's a lot of other people that are thinking the same as us. Not that they like the cut of our jib or anything, it's just that when a level of resistance is formed, as long as you don't get a level of support that's lower than the previous level of support, it means the trend could be carrying on. So in this case, resistance does get broken, and it occurs. Oh shoot! What terrible line is that? It gets broken right around here, and so that means this is where we would be entering our trade right in around. I'll try and do a nice circle for you. We'll be entering our trade somewhere right in there. And so then when we enter our trade, the next thing we do is, and so there's no interpretation here. If you are watching Apple, and Apple is in your fishing pond, and it's the one you're looking at, then this is the trade. This is where we would take our trade. We're not interpreting. There's none of us in this. It's just perfectly objective decision. And so then the next thing we have to do automatically is we have to put in a stop loss. So we're looking for a level of support, which is essentially the opposite to resistance, and the same type of rule applies. If support is broken, there's a lot of stop sells underneath support, which is where we're going to put our stop sell, and that means then that when that support is broken, there's a risk that the trend is in jeopardy. Now that's just a warning that it's in jeopardy. It takes another step, which again we go through in the course, but our stop would go somewhere in here, and so we've got our buy, we've got our stop, and we're ready to go. The price moves up, our stop buy is triggered in, and it continues on up. Now what happens next is there's a little bit of pushback right here, and it's enough to drive the price back below the blue. And our outlook now is, it's as though we came upon this trade for the first time. We came upon this situation for the first time, and we've kind of like setting in the background that we already have a position. If we had come upon this, would we be buying at this point? Would we be prepared? So let's go through it. Okay, so blue is above green, uptrend. Excellent. That's our setup. Then we've got the price and the red coming back above the blue, and excellent. Now we look to the left. Is there a price higher than right in here? Yes, just here, but it's not very far. So we can say, okay, if we get a close above this level, then we are buyers. And that takes place right there. So we are now buyers at this point, and our stop, our new stop, is going right here on position 2. But what we're doing now is we're going to take we're going to take our stop and we're going to bring it all the way up here on position 1. And what that now means is that we have crystallized position 1 so that we actually have profit and in position 1, and we've got 2 positions to go on up, and we have not added any further risk. So as we look at this, so our condition for placing our second trade is that where our stop goes, which is right here on position 2, is it above where we bought position 1, and it is. And so that means then that we've now got our second position, and we have not taken on any more risk because position 1 is now not only risk-free, it probably I haven't done the math on it, but it's probably got profit now crystallized, and the price carries on up. Now, what we end up with is a situation which we cover a lot in the course, and that's you've probably already seen an information session about rate of change, but right here we have a high in price unmatched by a high in the rate of change, which, as you know, is a warning, and we immediately put on a trend line, and once that's crossed, we're out right around here, and we're out of both positions, and both our trades are profitable, and that is good work by us. So we're out, that's all, nothing personal. The market isn't insulting us or doing anything. We are just out, and now we're waiting for our rules to be fulfilled to get back in. And you know what those are. We need the trend to be in the direction we want, and we need our trigger, and then we need to put our stop on after checking to the left. It's that basic, and we all the blocks that build on this are all covered in the course. And then you've got other ways of getting into a trade with patterns, which again you become objective. You set out the series of stocks that you're watching, or whatever it is. It can be commodities, it can be currencies, and you've got a sequence of those, and I'll show you. I show you how you define your fishing ponds. You're not wandering all over looking for things to buy. You know where you're looking, and you know under what conditions you would buy, and you know under what conditions you would get out, and that is how you become a consistent trader. So there's just one little aspect to cover now, and that's capital allocation, which we'll do right now. The final bit here. You've just seen a big move in Apple that obviously we couldn't identify down at the bottom, but as it unfolded, we were able to put on a second position, and sometimes the opportunity comes up to have a third position, and our only rule on that is when we place the stop for the next position, it's got to be either level or above the previous position. So you could have 3 or 4 positions. I don't know that you could ever get more than 4. It's usually in 4 sections, a big trend, and but that is the one rule. So then when we start out with our capital allocation, we want 10% of our portfolio per position, and so we've got we could have 2 or 3 on a big trend like that, as I said, and then where we put our stop is at 2% of the portfolio. So when you do your math and you see where your stop is, you want your risk. In other words, if the trade goes against you and you are stopped out, you don't want to lose more than 2% of your portfolio per trade. Now this keeps you trading. As your portfolio goes up, the 10% of the portfolio, that position obviously gets larger and larger by way of the percentage. And if your portfolio happens to be shrinking because you've had a few losses, then the 10% automatically adjusts the size of your trade downwards. I think you could see the wisdom of that. It's a very good and important process for you to follow. Again, we go through a few more rules in the course, but these are the core things for you to remember at this point so that you can take what you've just learned and you can use it right away. So that brings us to the end of this little lesson, and you can see there on the screen there's a page for you to go visit to see the basics of the course, and that I'll make it a live link down below. I'm not sure. I don't think you can live link it from the lesson, though you could just copy it if you want. But I'll put a live link down below, and you can email me if you have any questions. If you don't get anything, my email address is through a lot of stuff. So just send me anything, and even questions about your current trades, what you're looking at and what you're thinking, and I'm happy to help you out. No worries. Okay, so thanks very much for listening. I hope to see you soon down the road. Take care of yourselves, and bye now.